Okay, Scott Ashmore and Rob Halligan from Shuttle. How are you guys doing this morning?
Oh, great. Thanks for having us, Paddy.
Yeah, fantastic. Thanks for having us.
Where it's a Monday morning after the weekend in which Lions won the series down in Australia. We were just chatting on that. It was a nice win that we all got to watch.
It was a
Absolutely.
brilliant game of rugby. It was, yeah, coming down from 23-5 to win the game was epic.
Absolutely. None of us were there, unfortunately, in
No.
person. No.
No.
Maybe next time. Okay, guys, look at this interview came about. We bumped into each other, if that's the right term, on LinkedIn. And for me, I'm really interested to, I guess, share some explainers with our listeners around, private equity investing, venture capital, just to explain what that world is, right? As opposed to the public markets, which is, investing in direct equities or, listed funds, etc., that we would typically talk about here, right? The S&P 500, for argument's sake. So this is a very different world, and I'm really excited to share um, some more information around what this world is with our listeners, and to hear about Shuttle and the journey that you guys have had. So thanks a million for joining me. Um, when I was researching and preparing for our interview, one of the things that struck me on your website was I love graphs, right? I'm quite a visual person, as are a lot of listeners. And one of the graphs on your website is showing, if I understood it correctly, which I hope I did, you invest 2,500 per quarter. And by 2043, which is, I think, 18 years from now, potentially your investment via shuttle platform or venture capital ultimately could presume it's based on historical data, be worth 1.16 million on an investment of about 180,000 capital, versus the S&P 500 projected at 482. And I was like, okay, I need to hear more on this. I worked it out as an 18% per annum annual return. Where does that come from? Is that a realistic expectation? Is that what people can be expecting or hoping for from this type of a route?
Yeah. Well, firstly, I just to correct it, our minimum investments, which is actually a lot more accessible than that, than what you mentioned, is €250 per quarter,
Yes,
not 2,500 per quarter.
per quarter.
And yeah, you're right in your assumption that that is based on historical venture capital returns over the last 20 or 30 years. Scott can keep me honest on that. So just to give people an idea of what the potential projected returns might be. Obviously, no guarantees on those numbers, and there's some variables in there like there always are. But yeah, based on the historical returns we've seen in the asset class, that's what you could expect.
Awesome. That's it's pretty solid.
Mm.
Okay, so that is. Can you give our listeners a bit of a sense of a high level of the difference between private markets and public markets, as I said, that we would typically refer to, and where Shuttle fits in there?
Yeah, absolutely. So public market investing, like buying your Google stock for argument's sake, is where you are buying equities or shares or stock in publicly listed companies. So companies that are listed on the stock exchange, like the S&P 500, NASDAQ, etc., where people can trade in and out of those stock kind of freely at any stage. And the prices are quite stable typically. And obviously depending on the situation, but the jumps tend to be relatively easy, if you will. There's no crazy ups and downs there, depending, unless there's some kind of economic turmoil or something crazy happening in the market, which I guess is quite I guess not that unusual. Private equity, then, on the other hand, is the investment or purchasing of shares or stock in private companies, some companies that aren't listed on the stock exchange, companies that haven't IPO'd and gone public yet. So
Okay.
typically, your average investor won't get access to invest in private companies for the most part, or invest via private equity. tends to be reserved for large institutional investors, very high net worths, private investors get access to invest in private equity. Venture capital then is I guess, sits within the private equity realm or space, but is more geared towards the financing of earlier stage, high growth startups. And that could be companies in their infancy, all the way up to, where they're raising, Series C, D rounds of investment. So later stage, larger companies, they may have, thousands of employees and well established, but not public yet, haven't IPO'd, still within the private realm. But again, on their way towards potentially, listing on an exchange and going public. So private equity and VC, which falls underneath it, is again just investing in or purchasing equities within private companies, unlisted companies. And again, that's typically reserved for private investors, high net worth investors, and institutional capital tends to be what finances these companies, not typically open to your average everyday investor.
Okay. So venture capital, as VC, as you refer to it, is very well explained. Okay. And that sits within private equity investing.
Exactly.
You mentioned Series B, Series C. Can you explain Series A, B, C and what that actually means in the context of all of this, please?
Yeah, so private companies from their kind of infancy or their birth all the way up as they grow will have various fundraising rounds as they are required. No guarantees that any company will be able to raise capital. Obviously, that only happens off the back of doing well and seeing some success and growing, et cetera, et cetera. But as they aim to continue growing and may require some financing in order to do that, they'll raise a fundraising round. And these rounds are labeled as the company progresses. So in its infancy at the very start, you kind of see pre-seed. And then and this is when it's just getting off the ground. It's kind of an idea that's forming and starting to put some structure around and build out what that might look like. They may not have any revenues yet. Typically they don't, may not have any customers yet. But it's just an idea that's maybe being validated and there's enough assumptions being made to go off that there's something here and it's worth maybe progressing. After it's already kind of up and running and you might be generating some small revenues, some customers, then you might raise a seed round. And then from there, it's Series A, B, C, D. Now, companies might then decide to go public. You see some companies that might continue to raise, an E round for argument's sake. Companies are typically staying private for a lot longer these days. So if you take Stripe from a really obvious example, I think their valuation is about 90 billion, still private. Typically, 15, 20 years ago, a company like that would have long have gone public, a lot sooner in the life cycle. But there's an abundance of capital within the private realm now. So a lot of these companies don't see the need to go public necessarily and undergo the scrutiny that comes with being a public company and the expectations of being a public company when they can easily get access to capital to continue growing while staying private.
And so if I set up a company tomorrow, right, and we need to raise money or we need money to build it, to grow it, to trial it, right? That's where we might turn to Series A, pre-seed, possibly, or very early stage, right? Is that a fair summary on the approach? Why do companies, or why would I in that scenario go to private market investors versus going to my bank, which is traditionally where I would go for that type of funding?
I think banks would just see it as far too risky. I mean, it's called venture capital for a reason. It's, add venture capital, and banks just see that as there's just so much risk at that early stage. Banks would usually come in later in the process when a company's solved a few things, they've peeled a few layers of the onion off, and just a lot less risk. So in the earliest stages, in the pre-seed, seed, even Series A, Series B, banks generally wouldn't be involved, but maybe
Okay.
later in the process they'd start to get involved.
So it's around the C or D stage where you proven track record, maybe a couple of years of revenue and profit going, that type of an approach maybe is where a
Yeah,
company might turn to the banks.
where there's metrics there to really show that they've proven there's a need or a want for whatever it is they're offering, right? There's a market there for it. There's, customers, recurring revenue that's coming back, and they can see, okay, there's the business is somewhat established now, and a lot of the risk has been removed. Whereas venture capital is really like, it's a high risk, high reward asset class, right? So it is backing, starting a company is one of the riskiest things you can do. That even the most educated genius teams with the greatest ideas fail, and fail regularly, because there's so many variables, there's so many unknowns out there that can't be planned for. So even, great teams and great ideas fail daily, right? So it is a high risk asset class. But if you do strike gold, if you do hit a winner, the upside can be ginormous.
And so and again, just to keep it on the business owner's perspective for a second, which will relate to the investor's perspective in a second as well. So if I'm borrowing money from a bank, or if there's an angel investor, for argument's sake, somebody I know or an acquaintance I have that gives me money, as you said, it's a high risk, right? It's a bit of a gamble from that investor's perspective, based on whether this will work out and they'll get their money back or returns. I'm going to pay a premium on that money, right? So does the same apply in the private market space? If I'm taking money from investors, I'm going to have to pay a premium for access to that capital.
When you say pay a premium,
in terms of interest rate or repayment terms, etc. No,
because you're not borrowing this capital. You're not taking on. There is venture debt, which is a separate thing entirely. There's firms that provide venture debt, right, which is separate. But typically, angel investors, so individuals who are investing their own capital into the early stage companies, or venture capital funds who are investing into these companies, they're not providing debt. It's equity financing. So they're getting an ownership of the company in the hope that company goes on to do great things and provide a great return for that investment. So there isn't a payback period or an interest rate associated with it.
Okay, and I think that's an important distinction, right? For people, for the investor, then you're actually buying equity in this company, alone a stake of it. How do you arrive at fair valuations then for such early stage, whether it's A, B, or C? How did the valuations come about, and who does them?
There's no official way of evaluating a company. Generally, there's a lot of market data that shows you what similar companies are raising at any given stage. Okay. So you want to see a company's within those ranges, either the bottom quartile or top quartile, and then if their valuation is within that range, you can kind of be satisfied with that. Otherwise, if it's above that range, you want to see some sort of exceptional team that has gone and done this before, and they have a track record of building successful companies. So yeah, it's usually all based around the team and how capable they are of executing on what their vision is. And if you think they're a phenomenal team, then they can justify a higher valuation than would be within the market range. But otherwise, you should be looking for what other companies are raising at similar stages.
Yeah, obviously later stage companies, it's a lot easier to value, right, based on what their metrics, the direction that they're going, their growth that they've seen over the previous years, etc. In the earlier stages, obviously, without having a lot of those metrics there, it's more difficult to provide evaluation calculating in a similar way. So by using like the methods that Scott mentioned, Now, early stage companies, when you're talking about kind of pre-seed to pre-seed, seed, even Series A, like we're talking about valuations in the several million, with the hope that you're going to go on, these companies are going to go on and create a company worth hundreds of millions or billions, right? So the expectation is, and again, obviously, lots of companies don't make it. It's about having enough investments in your portfolio that you can enough shots on target, so you might capture one of those massive growers. But the expectation is you might invest, if you're investing pre-seed to Series A, at several million valuation, give or take, with the hope that that's going to go on and become a unicorn, a $1 billion plus company. It's not a case of, I might get in at, it's going to be worth 5 million and hope that they sell at 10.
Yes. You're going for a big. You're going for a big one. You're going 10x, yes. 20x, 50x, whatever it might be, right? And so out of interest, then that 18% kind of long-term historical return from venture capital, is that largely driven by a trend where, hey, 1 in 50 will be an absolute unicorn, or is there stats on the number that work out really, really well versus the number that just disappear into the ether?
Yeah, there's definitely a lot of stats out there, and I think what comes up again and again in venture is the power law, which essentially means that your returns, or the vast majority of your returns, will be defined by one or two companies in a portfolio of 50 companies.
Okay.
So the returns are heavily skewed towards the big winners in your portfolio. And we see this in public markets as well. Like if you look at the S&P 500, like the majority of the returns are driven by the Magnificent Seven companies. But in venture, it's accelerated even further than that. So yeah, okay. Only a couple of companies will be responsible for generating the vast majority of your returns in your portfolio. I think that brings us on to a point where portfolio construction is really, really important in venture capital. Like if you're only investing in 5 to 10 companies, it's not a good strategy in venture because those returns are so skewed towards the big winners. You need to be really well diversified. Diversification is your best friend in venture capital. So at around 50 investments, your odds of losing money are around 2.5%. And your odds of seeing a 3x return or greater increase to over 40%. So diversification is really important in venture capital. The more diversified you can be, the better chances you are of seeing one of those truly generational companies that's going to make a huge amount of returns for your portfolio.
Yeah, and and I think that is exactly what Shuttle's trying to do, right? It's our approach is how can we help customers build a broad portfolio quickly and get that diversification, because we're not trying to operate venture capital funds. Many funds operate in a very concentrated fashion. They have large teams of analysts around them, and they might have specific focus on a particular sector or vertical where they have great knowledge on, and they might really, really focus on that. So they might only make a handful of investments within that space every year. And then they'll still, over the course of, as they invest that fund's capital over the course of maybe 3 years, they might still build a portfolio of, 15, 20, 30 companies, but they're more of that kind of concentrated, focused model. What we're trying to do, and what the data is showing, is that diversified, broader approach gives you the greater chance of landing on one of those winners, and obviously reducing your risk significantly as well. So we want our customers to build that broad portfolio. So it's about how can we help them do that as quickly as possible.
Right. And I'm looking forward to getting into how the platform works and what the mechanisms are, etc. But just to stick on the general kind of trends, I see, according to some of BlackRock's data, the number of, this is US data, of course, right, which an awful lot of the good data knocking around is, the number of public companies in the US has fallen 24% since 1988. Don't ask me why it started in 1988, but reduced 24% since 1988. And the number of US private companies with more than 100 employees has gone up 46% in that same period of time. And And Larry Fink's letter, which I read every year, and he's usually pitching something, right? To be fair to him, he was talking about, you know, the to phrase it, growing mismatch between demand for investment and the capital available from traditional sources. And so he seems to be saying, hey, the number of public companies is going to continue to reduce. The number of private companies and well-established and decent privately owned companies is going to continue to increase, and they're going to continue to need funding for expansion and growth and acquisitions, etc. And that's just $25 trillion in banks and money market funds in the US at the minute, right? So he seems to think this is a trend that's going to continue on. As I said, look, he's probably pitching the BlackRock private markets funds, right, which has been around for a while. But for you guys, what are you looking at that is telling you this is the space to be in?
Yeah. So it started, myself and Scott go back 25 years as best mates before business partners, and we were investing together in various things. And we were both working in tech, and we were quite close to venture-backed tech startups, kind of various stages. So we naturally just saw this and wanted access to, right? Now, this is kind of going back 8 years ago or something like that, 8 or 9 years ago. And we realized very quickly that there's a number of barriers for everyday investors like us that, stop us from getting access to these things, right? It's regulation, it's closed networks, it's very high minimum investment. Now, fast forward to today, and we've seen a massive shift in the investor space. It is, the public market investor platforms like the Zero and Trading 212 and Trade Republic and all these have come about. They're incredibly popular. Investing is now no longer some niche thing. It's mainstream. It's part of the culture. Everyone seems to be doing it or talking about it. It's on YouTube. It's on TikTok. It's everywhere. And we're seeing a massive shift even generationally from, the kind of baby boomer generation to now Gen Z in terms of how many people are accessing this thing and investing on a regular basis. What we've recognized is, and just from doing a lot of the research is, and it's interesting you mentioned BlackRock, because if you go online, you can source multiple reports from your BlackRocks, your KKRs, your JP Morgans, etc., as well as all the big consultancy firms talking about this shift towards private markets, right? Public markets are investing in public equities is very, very typical for a lot of people. You can do it by whipping out your phone and opening Revolut, a couple of clicks, you can own a stock, etc. Private markets are now moving towards that shift. Retail investors or everyday investors own 50% of global wealth. Their allocations towards private market assets are set to more than triple, from 4 to 13 trillion over the next 7 years. So the expectation is there. All of the big asset managers of the world recognize the power of the retail investor, if you will. So the non-high net worth, non-private investors, non-institutional investors. And they're all now building out infrastructure and products to support these people. And again, I think a lot of it goes back to what you mentioned there about companies. Less companies are going public. They're staying private for longer. Why? Because it's easier for them. They can get the capital that they need to finance their operations without having to undergo the public scrutiny, reporting expectation, compliance, regulatory expectations of being a big public company, publicly traded company. So it makes it easier for them to if they can stay private and still get the financing they need. Unfortunately, what that means is that all of that investment that gets pumped into these companies while they're private sucks out most of the upside that the retail investor would have got access to when they floated on the stock market, right? So by the time they actually do go public, much of that upside has been extracted while they were private, okay? So how can retail investors like us, everyday investors like us, get access to these companies while they're still private? How can they share in that upside and with the success of those companies, right? That has to be possible for investors to be able to get access to these things. We're starting to see regulation softening both sides of the Atlantic, and we're starting to see more players attempting to offer solutions and products for people to invest, similar to Shuttle. We're taking a focus right now on the earlier stages, right? Which again, it's the riskier stages, but also means there's the greatest amount of upside should these companies go on to be successful. But I think we're going to see a number of players enter this space to support more people like us investing in private companies, whether that's in the earlier stages or the later stages. And I think it's a great thing to see, and I think it's something that's absolutely necessary for more people to have access to these things.
And so for you guys, you obviously went through a lot of trouble and effort and energy to create Shuttle. I saw you were in the papers last year. You got Central Bank of Ireland authorization to operate. When you guys see the Vanguards and the BlackRocks of the world having these private market funds, right? Now you'll pay 2% and a bit per year to invest in those funds, right? But again, they talk about historical performance of, I guess, 14% per year for the last 20 years from their types of approaches. So are they your competitors, or, in theory, retail investors could potentially access funds of that kind of ilk from those sorts of players? Are they your competitors, or how else would people be approaching the investment in private equity?
There's different ways of doing it. And yes, that's one way of getting access, but they're not investing directly. If you're buying into those funds, you're not buying equities directly in those companies, right? You're buying shares of that fund. It's slightly different. With investing via Shuttle, you are owning equity directly in these companies. You're owning a stake in these companies. I think of Vanguard, JP Morgan, BlackRock, etc. We don't see them as direct competitors. I don't think that younger generations of investors, your millennials and Gen Z investors, relate to those companies in any way, shape, or form. I think nowadays people care about brands. They care about the companies that they're engaging with, regardless of what it is they're purchasing from them or services that they're purchasing from them. And I think those old legacy financial institutions don't represent a lot of the customers that we are, who our customers are. And I think for that reason, a lot of people wouldn't necessarily engage with them that we're going after, that we see ourselves as our ideal customer kind of profile, that kind of Gen Z millennial profile. So yes, they do offer investment opportunities. So in that regard, they're an indirect competitor as such. But I just don't think that they will capture the same type of audience as who we're going after. So, of course, yes, you could go to a JP Morgan, a KKR, and you'll find many different opportunities to invest in different things, whether public or potentially private, depending on what offerings they're offering now in the private space. Won't necessarily be the exact same thing. You won't necessarily be owning direct equity in those companies. And again, I just feel like the customer profile is slightly different to what we're targeting.
Okay. So can you explain to us how your approach works then, right? So as you said, it's about establishing a diversified portfolio as quickly as possible to help increase the odds of success, right? How does that actually work on the Shuttle approach? And sorry, you guys got Central Bank of Ireland authorization to do what specifically, and how does that carry over?
Yeah, so the central bank authorizations essentially allows us to invest in private companies, allows us to help retail investors invest in private companies. And that could be professional retail investors or non-professional retail investors. And basically allows us to invest in private companies of any stage up to 5 million per investment annually. So it's quite a broad amount of things we can do with the authorization. And it gives us the freedom to do exactly what we set out to do. So yeah, it's essentially the ability to help retail investors invest into private companies.
Okay.
Yeah.
Okay. So explain the logistics then. So I'm an investor. I want to send you guys some money every quarter. How does it work?
Yeah. So right now, what we do is as Scott said, we allow people to invest in private companies. We do that on a deal by deal basis. So myself and Scott have kind of built a network over the last couple of years as we've been working on this and working through our authorization with the CBI. And worth mentioning as well, like we're authorized by the Central Bank of Ireland to support investors across Europe and not just here in Ireland. So we can support investors across Europe to invest in companies globally. Companies that are domiciled globally. So how it works ultimately is that we have built relationships with venture capital funds and founders and people within the space. And we use that network to get access to founders who are raising capital in the early stages. And we look to negotiate access to their fundraising round. And that round would have multiple investors involved. We always will only be investing in opportunities where there is at least one venture capital fund leading the round. So we won't be investing in companies where it's just individual angel investors investing. Ultimately, what we're doing is we're selling access, right? We're selling access to an asset class that ultimately would be out of reach for the vast majority of investors. So we get access to venture-backed rounds, so rounds where there is a venture capital fund whose sole job is to invest in these companies, who are leading the round, setting the terms, providing a kind of institutional level of due diligence happening on their side to the company. We negotiate an access for our community to get into that round. So a company might be raising, for argument's sake, 2 million. That VC fund might be taking 1 million of that. They could be taking 1.5 million of that. And then the leftover might be filled by potentially another venture capital fund, maybe multiple other funds, angel investors, etc. We'll negotiate an allocation, so a portion of that our community can then fill. So that's how we're doing it at the moment. How we're doing that on the kind of customer side is every quarter we'll release what we call a drop, which would be kind of a grouping of 2 or 3 companies that we've sourced. The end investor who signs up to Shuttle, they create an account in Shuttle, they top up their account with investable funds, and then they can access and see. We release those drops every quarter, and they have all of the information on the companies. We provide information on the team, the background, what it is they do, the market that they operate in, the problem that they're solving, etc., technology that they're building, so that the customer can get acquainted with the business and also build conviction as well, and get fully understanding in what it is that they're investing in. And then they can decide if they wish to invest in that drop. And if they are investing in that drop, they're investing in the 2 or 3 companies within that drop. So they're not kind of picking and choosing. I might put, some of my capital into this, none into this, and maybe a smaller amount into this. And again, that's for us to help them try and build that kind of broad approach, investing and building that diversified approach into their portfolio. So they're getting the ability to invest in multiple companies at once. And again, so that's the process, and the process repeats every quarter. We'll release a new drop of new companies. So we've done 3 drops so far since we launched in December. We've just closed one up on Friday, just gone, a couple of days ago. So that's our 6th company in the Shuttle portfolio, which is fantastic. Where we're going with this, that's what we're focusing on at the moment. Where we're going down the line is ultimately to get people greater access to the asset class, where we want to give them the ability to actually invest directly in venture capital funds. So right now they're investing on a deal by deal basis directly in each company. How can we give them access to invest directly in the venture capital fund itself, which kind of increases diversification further and gives them the ability to potentially invest in a fund that focuses on maybe an area that's of interest to them, whether that's a particular type of technology, certain sector, et cetera, et cetera. So that's kind of the direction that we're going.
And okay, so if I understand correctly, as you said, it's every quarter. There's typically 2 or 3 drops, opportunities, 2 or 3 new companies potentially for people to access if they wish. So on that type of approach, is it fair to say it's 8 to 12 companies per year, right? Yeah. So it will take 4 or 5 years to get the 50, 60 kind of holdings, as it were, in one's portfolio, right? Yeah. And so this venture company fund that you speak of, is that something that you're setting up? Are you building a fund, or are you trying to select one that's out there? How does that actually work? Or is that what you're building over time?
Yeah, so just to go back to the 8 to 12 companies a year. Yeah, we're targeting about 12 companies a year. We think that will probably ramp up as we scale as well over the next couple of years. It could be, start with 8 this year, 8 or 12 this year, and that might increase then to maybe a drop every month for argument's sake. So we might get there faster than the 5 years. But yes, the expectation is over the course of a number of years, you'll build up that really broad, diverse portfolio with us. In terms of the funds, we're not raising our own fund. We're looking to get access to venture capital funds. So build relationships with VC funds and essentially use our infrastructure and technology that we've built and regulations that we're authorized under and will be authorized under in the future to essentially allow our community of customers to pool those individuals together to access the VC funds. Okay, so these VC funds might typically, the minimum per investor might be in several 100,000 or several million, depending on the size of the fund. Obviously far out of reach for any individual everyday investor. So how can we allow them to get into the venture capital fund while still making it valuable and simple for the fund managers, right? Because typically trying to manage, hundreds, thousands, tens of thousands of individual smaller investors, it just doesn't make sense for them. How can we make that make sense for them?
Okay. So in terms of timing, so one of the big, in my experience, one of the big questions or considerations for people when they're investing, as opposed to just depositing, but when they're investing, is time frame and exit. How does that work in this world?
Yeah, so venture is a long-term asset class. I think it's highly liquid, and you can expect that you won't see a return for anywhere between 3 to 10 years, usually between 5 and 10 years, and it could be even longer than 10 years in some cases. So yeah, it's very, very long term. We'll always look for opportunities to give investors some liquidity along the line. So if a company's raising a big Series B round and we invested in the seed, we might see if there's an opportunity to kind of liquidate some of our shares in that round if the customers would like that, and give them sort of a return from there. But then again, there's M&A that can happen after 4 years. A company might be sold entirely to a Google or Amazon or something like this, and they would exit their position sooner than anticipated. But the bulk of returns tend to happen around the 8 to 12 year mark, and that's when investors see the most liquidity from their investments within venture capital. And that's just what it takes. It takes time for these companies to mature into big companies and ultimately, go on to IPO or a big M&A or whatever it might see. So yeah, it is a long-term, highly liquid asset class.
Yeah, and I think that's worth, for the investors who might be interested in learning more about it or exploring it. This isn't for the people who've never invested before. All right, this is for people who are already investing in public equities. They might invest in a number of ETFs that maybe track the S&P 500. Maybe they invest in ETF that tracks, whatever it might be that they're interested in. Maybe they have some individual, stock picks themselves as well, or whatever. They have their pension in place, and they want to explore putting a portion of their portfolio, maybe 5, 10, 20% of it, towards potentially higher yielding asset classes that are, higher risk, more speculative, but potentially very high rewarding asset classes, right? So that's what this is for. It's for the investors who are, they've already have their other pieces taken care of. They already have invested in some public equities, et cetera, or whatever it might be, and want to explore some of the higher yielding asset classes as well, and are willing to put that money to work, right? So, yes, it is an illiquid asset class. It takes a number of years, naturally, as you can expect, for companies to mature and grow into, the big companies that, we're all sort of familiar with. So you have to be willing to, if you're investing in it, to expect that money is going to be locked up for that period and go to work for you for that period. As Scott said, we will always look for opportunities. Something that we're going to be exploring ourselves is having a secondaries marketplace on platform as well, where some of our customers can potentially sell their stakes in some of these companies again in future rounds, or to other investors on our platform. But again, it is expected that you're kind of going to be waiting for the kind of 5 to 10 years.
Okay. Yeah, and I suppose that's a very good point, as you say. Look, make sure you have all your other areas boxed off, and this is for for maybe surplus cash or cash that you don't have a need for at any particular point in the future, right? I have a couple of clients that I work with that have legacy PE private equity stuff through some of the well-known fund companies in Ireland, and there's no sign of liquidity, although they'd like it out, right? So is that a fair kind of health warning with this? Look at the exact date on exit and what that will look like really is out of our control. Is that fair from the investor's perspective?
Yeah, ultimately, yes. We can, again, like public equities, you can't just trade in and out of this stuff daily, on a typical platform that we're all familiar with. One of the many platforms we're familiar with. So because these companies don't trade on stock exchanges, right? So if you're investing in these companies, it's with the expectation that I'm going to invest in these companies because the potential upside can be exponential, right? And I want access to be able to get, to share in some of that potential success because it can be ginormous. But also it's an illiquid asset class, it's a high risk asset class. So I have to be prepared to lose money potentially on some of the investments. Some of them, ultimately companies will fail. And some companies, if they do go on to do well, will take time, right? So the point of what we're trying to do is with that broad, diverse approach is that if we can help build you a large portfolio, you can weather the storm of some of those companies. Ultimately, either, some of them will not do well. Some of them will return, maybe even returns or no money. Some might give you a 1x, 2x, etc. But with the point that we have enough shots on goal, if you will, so that we capture and spread the net wide enough so that we can capture those ones that go on to give you the 10, 20, 50, 100x returns or more that it might be.
I know some listeners would be thinking, oh, so is that the case? If I'm investing in these directly and I have a couple of losers, can I use those losses against capital gains tax that I'll, on the winners, so to speak? Because I own it directly, that's the approach we can take here, right?
Yep.
Okay, that could be useful, particularly given the fact that you're expecting a reasonable amount of them to be losers, right? Okay.
And it's worth noting as well, like on that, like, we'll never put a company in front of our customers that we don't have complete conviction in, right? Yes. These are companies that many investors are backing, professional VC funds are backing and writing checks for, where a lot of people think these have what it takes to go on and be winners. But it's simply because, which is just how this space works, because there's just so many variables and uncontrollables out there. Even the greatest looking teams, the greatest looking technology and products can falter for unknown reasons or reasons that just can't be seen until they actually happen. So I guess it's just not a case that like, oh yeah, we know these companies are going to fail. It's just, that's just kind of the expectation. Some will run into trouble and won't make it. We don't know which ones they will be. Hopefully there'll be very few of those, but that's just kind of, being the realistic outlook.
Yeah. And look, you mentioned Stripe earlier on. For every Stripe, there's probably 100, that have disappeared,
Exactly. That look just as good.
Potential at the outset, right?
Yeah.
So, okay. So interesting. So the exit for me, so I'm thinking of you guys, you've set up the Shuttle, you've set up a business, obviously to be a profitable business. Your fees are €250 a year, if I'm correct.
Yeah.
Per account. So that's the maintenance of the account on the platform, and a 10% performance fee on successful exit or on gains, realized gains. Is that a fair summary of the fees?
Yeah, so €250 a year to be a member of the community and get access to the curated deal flow, and then 10% profit share on the back end.
So I like that term, profit share. In terms of that piece of exit, so for you guys to make that piece, right, that 10% profit share, as you call it, people have to have exits, right?
Yep.
How do you balance that? Because you'll want exits to happen, obviously, right? But you can't create them out of nowhere. Or is that what the secondaries is allows, transaction flow?
Yeah, secondaries will allow that. But I think the point of the 10% success fee that we have is really to show that like we're aligning incentives here with our customers, right? We want like we have full belief in these companies to go on to do well, which is why why we have that there. We don't want to take a transaction fee up front or a portion of the invested funds, to ourselves, which is what you might see from other companies or other platforms. We're putting our belief in these businesses. So we'll earn when you earn, right? And only after you've received your initial investment back and you've made a profit will we take that 10% fee. So it's really about aligning incentives. And that means that we'll be waiting just as long as our customers will be waiting to see those as well, right? Now, again, as as Scott said earlier, we will look for opportunities along the way. If we've invested at pre-seed or seed and maybe that company's gone on, it's done well over the next few years, it's now raising a series B or whatever it might be, and there's an opportunity to realize some liquidity and make a small exit or selling a portion of those funds, we'll do that. Again, whatever we feel the customers' preference is or what they'd like to do.
Sure.
But for the most part, we're going to be waiting along with you for those exits to happen.
And I love the ethos of that, right? And as you said, look, there's pros and cons to every approach. Like I mentioned the BlackRock fund earlier on, all in, it's probably 2.2% a year annual fee there, right? So you could say, well, look at over the course of 5 years, 4 years, probably, our 10% on exit is equitable with that. And you realistically will expect to be waiting a lot longer. So I think that's fine. But for you guys as a business, you've obviously factored this into your planning, if, cash flow for the business, to make sure that there's exits there. How do you navigate, okay, let's stay in the right things versus, well, Jesus, we need to generate some revenue here. So let's go ahead and push this exit.
I think revenues for us is predominantly focused on our, subscription fees, and it's about scaling the community to a large enough size where they're, supporting the company. That's what's going to keep us operational, right? And obviously the success fees are the cherry on top. Like it's where the larger chunks might come in down the line, where obviously our customers are receiving their big windfalls, hopefully on these exits. That's where we'll see those as well. So in terms of operationally and getting to profitability and keeping the lights on here at Shuttle, it's really about scaling the community size and bringing in those annual fees for us.
Yep.
And as a matter of interest, where do those members come from? How will they find you? I suppose maybe it's doing podcasts. You'd want to go bigger profile than Informed Decisions now for that purpose. But how do you intend scaling, and what does that potentially look like in your eyes?
Yeah, so we've already kind of done some work with affiliates, kind of financial content creators on YouTube. We'll probably scale that up. It's what a lot of other financial institutions do. The more kind of younger financial products like Robinhood, DeGiro's, eToro, stuff like this, they use a lot of financial content creators. So we'll bank on that as well. Like up until this point, we've done a lot of founder-led content. So we create content ourselves and post that on LinkedIn and across other social channels. And we'll continue to do that. And just continuously social posting, working with influencers. Eventually, we'll do some paid marketing ourselves. I think that's the main
approach.
Yeah.
It's interesting, actually. I saw there's one of the influencers is in a bit of hot water there. I think came out on Thursday or Friday, right? About promoting, I don't exactly know what it was. I didn't read too much into it, but it was promoting some platform or some particular product. It's a bit of a gray area there, right? What's your thoughts on, the influencer space and how that crosses over with advice, or what is or isn't advice?
Yeah, I think it's just about having the right risk warnings in place and making sure the language is correct, that they're saying, first of all, they need to make sure that they are highlighting that if they are putting up content that's related to Shuttle or other institution, that it is related to that company, right? This essentially, the hashtag ad that you see across social channels with obviously some more language and structure around it related to the regulations. And so that's kind of the first protocol. It's making sure that the consumer can tell that the piece of content they're looking at is related to X business and why they're seeing it, or why that content creator is creating that piece of content about that business, right? So that no one's being duped into believing anything that they shouldn't, and that of course whatever is being said is absolutely factual and correct, right? And I think any finance creators probably should at least be well aware by now that what they're saying should not be taken as financial advice or deemed as advice unless that person is qualified to give advice, right? So I think it's really down to the content creator or the affiliate in question. And for companies, I guess that means using trustworthy content creators and affiliates that have built a relevant audience and community, and who, it's pretty obvious, it's pretty clear to spot the ones that are doing it right and the ones who aren't, and making sure that you're always on the right side of that line,
Yeah. I think there's still a lot of the wild west crypto stuff going on, whereas we are regulated by the Central Bank of Ireland. So we've got policies and procedures in place to make sure that any content is going out that has to be reviewed and verified that it's fair, clear, and not misleading to potential customers. So there's a lot of guardrails to make sure we're putting out the right content.
And once a client or a potential member finds their way to your door, given the sophistication and the non-mainstream type of assets and approach to investing that you guys facilitate, how do you kind of ensure that only people who really know what they're doing can become members and get invested? What are the kind of approaches that you guys take to protect people ultimately?
Yeah, well, I mean, in terms of the sophistication or anything, it's important to make it clear, investing doesn't have to be confusing or convoluted. And I know you can go onto a lot of public market investing platforms nowadays, a lot of brokerage platforms, and they can be very confusing because there are so many products, there are so many funds and ETFs to get into, charts everywhere. And I think that's kind of a bit of the problem with investing. Although it's become very mainstream and part of the culture for a lot of people also still are slightly turned off by it because they're kind of going, what am I doing here? And it's because those platforms over the last kind of 10 years that they've been around have grown very clunky and convoluted, because as opportunity, as investment products have grown, they've kind of kept adding to the platforms, to support every type of investor and every type of interest, right? So it can be quite confusing. Shuttle is, for us, our core value is simplicity. How can we make it incredibly easy and simple and enjoyable an experience for the customer? So you're not going to find all of that, the similar approach or the similar user experiences you might on a lot of the public market platforms. We want to make it very, very simple for people, first and foremost, so that people don't feel like overwhelmed by all of it. So that's the most important thing. The other side of it then is ultimately, we provide and include all of the correct risk warnings as per the regulator that's required on the platform. When you come on, we ask questions around what's your net worth, and then there's limitations in terms of how much you can invest to try and protect the consumer. Additionally, to make sure that they aren't going and coming in with investing all of their capital in this, because as I said earlier, we're looking for people who are probably already have some investor experience and have taken care of maybe the basic foundation layer of investing in, your ETFs or whatever it might be, and then they want to explore some of these additional asset classes like VC. So we have that in place for them, and again, it's really it's about education as well. So we try and we create content around this that goes out regularly. So we want people to kind of understand that we put out twice weekly comms to our community as well via email, also about what we're doing, what we're building, how we're progressing, about the opportunities that we might be looking at. So number one, it's about us doing the right thing as per the customer, make sure that the right risk warnings in place, the right language is being used on the platform, the right protections are in place for the end user. And then on the other side, the more kind of marketing and comms side, it's about creating educational content to help bring people up to speed in terms of private market investing and investing in private companies, etc. So it's just kind of piecing those two bits together.
Super. And look, I'm a firm believer in education is power, right? Because far too often it's the lack of understanding, it's the lack of information out there that that keeps people in the dark,
Yeah.
right? And that leads to mistakes. So yeah, that all sounds really, really positive. Okay, is there one myth that you'd like to debunk about private market investing? And if so, what would that be and why?
I think just going back on that, like kind of that education piece is, I think a lot of people make assumptions, and kind of rightly so, because they've probably been led to, they've been led to believe this way, is that investing in things like anything private market requires you to be very wealthy and have lots of money. Okay. And understandably, if people think of people who have any kind of insight into it or understanding of it, think private markets, hedge funds, private equity funds, venture capital, big institutional investors or very high net worth, wealthy individuals, etc. So typically, that's the expectation is that's a world not that I don't belong to. So I think it's important to note that that's not the case. Okay, there is opportunities for people to get access to this stuff, to invest in private market opportunities for low amounts to small amounts, and not necessarily needing really in-depth experience or understanding or education on it to start. Okay, like with anything, like investing in public markets, it's really about starting and starting small, starting with something that you're comfortable with. Shuttle is providing that type of access. There's people who want to access this stuff, who aren't looking to invest tens, hundreds of thousands in these opportunities, but still want to get access to these potentially higher yielding opportunities. So I think that's one of the biggest myths, is that you do not, and that's for investing in general, I think, not necessarily just private markets. You do not need lots of capital to get started and to get going.
Awesome. And finally, and I'll ask you for a book recommendation in a second, so I'll just let you chew on that one for a second. What type of companies would people expect to see under the bonnet? Is it tech companies? It'd be kind of the assumption that a lot of people would make. Is that where it's at? Is it 80% tech, 20% infrastructure and other stuff? And where are they? Is it US? General sense of what you're seeing or what your expectations are going forward.
Yeah, so far it's been kind of predominantly Ireland and the UK in terms of the companies, and pretty much 100% tech. That's what our focus is on. That's the background myself and Rob came from. That's kind of what we understand. It's what's familiar to us, and it's what we feel comfortable, putting in front of our customers. We're looking to do more, expand our geographical reach to the US and to mainland Europe as well over the next few months. So we think diversification is not just about how many; it's about geographies, like how many different geographies can you invest in as well. So yeah.
Excellent. Thank you. All right, Rob and Scott has said, I ask everybody that we chat with here for a book recommendation. Can be fact or fiction, related to what we're talking about, or totally not, but a book that stood out for you, or that you've read recently that was really enjoyable.
Yeah, I read a book a few years ago, and I ended up going back and kind of reading the notes that I'd taken, that I'd highlighted in my Kindle. A book called Grit by Angela Duckworth, which is a great book. It's kind of about passion and perseverance. It's about not necessarily needing to have the educational background or the training or whatnot, or the natural skills in a particular topic or whatever it might be to be successful at it. And it's really about it persevering within that realm, and the effort and workload that you're willing to put into something to become a master of it. I think it's kind of quite, probably for me, it was quite relevant in building a young company and what's required in order to get it off the ground and make it a success. So yeah, it's a great book, but I think it's relevant for anybody, not necessarily if you're a founder, and regardless of what you're doing or working in. I think it's a great read.
Yeah.
We could all do some great. Angela Duckworth, Grit. Brilliant. Thank you, Rob. Scott.
Interesting one there. Mine's along a similar guys. It's one I actually read when I was in my first year of uni, which was Outliers by Malcolm Gladwell. A very familiar book to a lot of people, but along the similar vein, like what it takes to become a true outlier, or what the true outliers of our world, how they got to where they were. So yeah, similar vein as Grit, but another just a fascinating book that I've been wanting to read again over the next couple of months.
Nice. Look at no doubt you're hoping to be outliers yourselves going forward. So the best of
Absolutely.
luck with the shuttle journey. We'll certainly keep an eye on it from here. And thanks a million for coming on and sharing all aspects of private market investing and what you guys are doing. I do appreciate your time, and hopefully it's helpful for our listeners and indeed for yourselves.
Likewise,
Absolutely.
Paddy.
Thanks for having us,
Appreciate the
Paddy.
time. Thank you.
Thank you very much. Bye for now.
Bye bye.